Let's talk about all of this right now with Jeremy Siegel. He is Professor Emeritus of Finance at University of Pennsylvania's Wharton School of Business. He's also Chief Economist at Wisdom Tree. Jeremy, what do you think, just in terms of where we are headed this morning, how the world is reacting to the trade war that's kicked off primarily between the United States and China at this point?
Yes, good morning, Becky. Listen, I've looked at the data, and I do believe there are persuasive economic reasons for the Fed to aggressively lower interest rates right now. I know that Steve just a little while ago saying, show me some evidence, data that shows this. Well, one of the Fed's favorite indicators for long-term inflationary expectations is called the five-year forward rate of inflation. I know that sounds technical, but it really isn't a complicated issue. By looking at long-term inflation contracts, 10-year and 5-year, you can extract out the near term and look at those long-term. And these are market-based contracts. We know we're going to get an increase in inflation in the short term from the Trump tariffs. I call that the Trump bump. We're going to get there. But what we need to wonder about, is that getting into long-term inflationary expectations? That's exactly the topic that Jay Powell was worried about last week. Is that getting into it? The answer is definitively no. Actually, I've been looking at those long-term inflationary expectations, and they've actually been going down.
Jeremy, you yourself, a week ago on Wisdom Tree, you wrote, while the Fed has cover to ease, the mixed signals from the bond market complicate the picture. You said that with the yield curve no longer inverted, the case for Fed rate cuts weakens.
Well, you're right. And now it's just about flat. But this is before I looked at the case for these inflationary expectations. And right now, after the next 5 years, the long-term inflation expectations is 2.3%. And that's based on the Consumer Price Index. And the Fed's favorite indicator is the Personal Consumption Deflator Index, the PCE index. And that's about 0.3% below that. So really, on the PCE, the long-term inflationary expectation that the Fed itself uses, that Chair Powell has talked about, they've used this for over 20 years, is now at 2%. So, on that standpoint, I think there's a lot of it. And by the way,
so forget about the bond market. It's a week later. We're feeling good about things, and we should go ahead and
Well, the bond market is, I think the bond market's being disturbed by a lot of things going on, and things about the independence of the Fed and all sorts of other situations. And in fact, I think the Dow would improve actually if Jay Powell actually lowered that rate. Another factor is that money and credit are just not growing fast enough. Over the last year, the M2 money supply has grown less than 4%. For a healthy economy, you need between 5 and 6% money growth. It's actually lower than it was 3 years ago. And the only way for the Fed to actually stimulate loan growth, to stimulate money growth back to a healthy level, is by lowering those interest rates.
So you're concerned about the Fed's independence, because I got 2 points from you. One was that there are good economic reasons for Powell to lower rates. The second is that the threats to Fed independence are real and growing. So you're worried about the Fed independence, but you think he should cut rates.
Yeah, and let me say that, listen, let's face the facts. If he doesn't cut rates and we have a recession because of the tariffs, who is Trump going to blame? Trump is going to blame Powell. And the Republican Congress is not all that friendly toward the Fed to begin with. Don't forget the whole
So you
Federal
basically
Reserve.
think he should cut rates to make sure he keeps the Fed independent. So listen to you, not Trump, but do this to make sure that the Fed independence isn't threatened.
I actually think Fed independence is enhanced, the probability, by him cutting rates right now.
You think inflation, Jeremy, you think inflation is
doing what he wants.
You believe those recent prints on inflation?
The recent prints on long-term inflationary expectations are down 30 basis points since Fed took office in January.
So the real risk
that is exactly
Yeah, the real risk is the economy. I agree
Absolutely.
with you.
The real risk right now is the economy. And those inflationary expectations into the long term that Powell said he's concerned about on the actual data is not present at the present time.
Tariffs can cause, I think it's more likely, unfortunately, for some, I think it's more likely tariffs can cause a growth slowdown. And the inflation is sort of a one-shot deal because you don't get, unless it's a trade war with you keep tit for tat and because it's a one-shot deal. It's not the second derivative where inflation keeps the pace of increases keeps rising instead of just the first one. So
absolutely. Yeah. And let's say, Joe, you believe in the poly market and the markets right now. They're saying nearly 60% chance of inflation. All Wall Street firms have raised their rate. So you have red flags there. You have inadequate money and loan supply growth. You have long-term inflationary expectations at the level the Fed wants. Why not? And by the way, if the economy, if things go well, we don't have a slowdown, don't have a recession, then the Fed goes back up. This idea that the Fed is like a battleship that, moves slowly, it goes in cycles of years and all that, is just not supported by evidence, not supported by theory. They could move back if need be, but right now, the data is flashing red for me to say lower those interest rates.
Is there any call for the Fed to kind of wait and see this out? I mean, you've changed your mind over the course of a week. Maybe they should wait and see what they think over the next month or so.
Yeah, well, I mean, when I'm taking a look at the data that I've seen over the last week and, rethought that, I mean, listen, we were back in inverted territory. We went above because I think all the problems of the dollar. So I think that term structure signal is not as strong. By the way, right now, I think it's virtually flat. And normally you're supposed to have approximately 100 basis points higher on the long rate than the short rate. So right now that argues for a Fed funds rate that's not 4.33%, but 3.33%. And I think, honestly, the Fed should start in May and continue in June. I mean, the European Central Bank has lowered 7 times, and the long-term inflationary expectations are going down. And listen, you're not going to have a sustained inflation with money supply growing at an inadequate amount. That's never happened in history. I mean, we had 34 years between 1986 and the pandemic when the money supply was growing 5.5% a year. And then it exploded under, Powell. He talk about independence. He caved in to Trump and Biden's excessive fiscal spending. So, and that was a case that caused all that inflation back there. Right now, the Fed's favorite indicator of long-term inflation expectations is signaling that he is able to cut interest rates now.